All right, let's get right to it. Today we're going to tackle one of the biggest and honestly one of the most dangerous traps in all of investing. We're going to peel back the layers on the market's favorite shortcut so you can learn how to spot what most people completely miss.
You know the question. It's the one every single one of us asks probably a dozen times a day. Is this stock cheap? And of course the market has this go-to answer for you, right? A single number that's supposed to tell you everything.
And that number is, yep, you guessed it, the price-to-earnings ratio, the PE. But here's the thing. Relying on just this one metric, it's like trying to find your way around a huge city with nothing but a single street name. It's a shortcut for sure, but it's one that often leads you straight into what I call the single metric trap. And that's exactly what we're going to deconstruct today.
You know, the famous valuation professor Aswath Damodaran put it perfectly. He said, a sound valuation is a marriage of narrative and numbers. A number by itself is pretty much meaningless if you don't understand the story behind it. So that's our goal today. We're going to learn how to actually read that story.
All right, so where do we start? Well, let's start with the first piece of the puzzle, the E in PE. Now that stands for earnings, obviously. But trust me, it's not nearly as simple as it sounds. So what is it really? Earnings per share, or EPS, is basically the slice of a company's profit that gets assigned to each single share of stock. It's the bottom line indicator of profitability for you, the shareholder. Think of it like this. If the company's profit is a giant pie, the EPS is the size of your slice. But, and this is a big but, here's where things get a little tricky. See, companies actually report two different kinds of EPS. You've got basic EPS, which is just a simple, here's where we are right now number. But the pros? They almost always look at diluted EPS. So why is that? Well, because diluted EPS asks a crucial what-if question. It factors in all the potential new shares that could be created from things like employee stock options. It's the more conservative, kind of worst-case scenario number, and that's exactly why it gives you a much truer picture of a company's profitability. And check this out. That gap between the basic and the diluted EPS, it tells you a whole story about risk. If you see a company where that gap is super tiny, like the one on the left, that's a good sign. But a company with a huge gap between the two, whoa, that's a red flag. It's telling you there's a big overhang of potential new shares just waiting to be created, which could seriously water down your ownership stake down the road. It's a warning sign hiding right there in plain sight. And here's something you absolutely have to get. The number of shares, the S in EPS, it's not set in stone, not at all. Management can and does pull levers that change the share count, and that can change the EPS number, sometimes without the actual business getting any better. So how do they do that? Well, there are basically three big ways. First, you've got share buybacks. The company uses cash to buy its own stock, the number of shares goes down, and poof, EPS goes up. It's just math. On the flip side, things like paying employees with stock or issuing brand new shares to raise cash, well, that does the exact opposite. It increases the share count and dilutes your piece of the pie, pushing EPS down. It's this constant tug-of-war. Okay, so we've deconstructed the E. Now let's put it all together and tackle the full PE ratio to figure out what it's really trying to tell us.
Right. The textbook definition is super simple. We all know it. Price divided by earnings. So if a stock has a PE of 20, it means you're paying $20 for every $1 of its earnings. Easy enough. But that is just scratching the surface. What the PE ratio really is a measure of the market's expectations for the future.
And that PE number is basically being pulled in two different directions by two powerful forces. On one side, you have growth expectations. The more growth the market expects, the higher the PE it's willing to slap on that stock. But on the other side, you have risk. The riskier the business seems, the lower the PE investors are going to give it. It's always a balancing act between that future promise and the present-day risks. And just like with EPS, the PE ratio has two main flavors you got to know about. First, there's the trailing PE. This one uses the earnings from the past 12 months. It's a hard fact, it actually happened, but it's looking in the rearview mirror. Then you have the forward PE. This one uses Wall Street's best guess for what earnings will be in the next 12 months. So it's forward-looking, which is what we want, but hey, it's just an estimate, and estimates can be wrong. You're basically trading the certainty of the past for a guess about the future. Okay, so this sets up a really cool little analytical trick. Let's say you're looking at a company and you notice its forward PE is lower than its trailing PE. What does that immediately tell you? Just think about the math for a second. The P for price is the same in both. It means analysts expect earnings to grow. It's just simple math, right?
For that forward PE number to be smaller, the E on the bottom of the fraction has to be bigger. So a lower forward PE is a quick and dirty signal that Wall Street thinks the company is going to make more money next year than it did last year.
Okay, let's get to the really critical part now. We need to talk about why a stock that looks cheap on the surface can end up being the single most expensive mistake you ever make as an investor. We're talking about the dreaded value trap.
See, a low PE isn't a green light to buy. It should be a giant, flashing question mark. You have to ask, why is it so low? Is it because the company's in a dying industry with zero growth prospects? Maybe it's buried in debt or facing some massive business threat. Or, and this one gets people all the time, for a cyclical company, the PE often looks lowest right at the peak, just before its earnings are about to fall off a cliff. The market isn't stupid. It's often pricing that stock low for a very good reason. It's not cheap, it's just correctly priced for a terrible future.
And this all leads us to what might be the single most important question in investing. It's what separates the good companies from the truly great ones. It's not just, is the company growing? The real question is that growth actually creating any value?
So how do we answer that? Well, we need another tool, a metric, called return on invested capital, or ROIC. The easiest way to think about it is like a company's report card. It tells you how good management is at taking all the money they have to work with, from shareholders, from lenders, all of it, and turning it into actual profits. It's the ultimate measure of how smart a company is with its money. And we compare that report card grade, the ROIC, to something called the weighted average cost of capital, or WACC. Now this just sounds complicated, but all it really is the company's cost of money. Think of it as the minimum passing grade. It's the hurdle rate that any new project has to clear to even be considered a good idea.
So here is the golden rule, the absolute key to everything. If a company's ROIC is higher than its WACC, then every single dollar it plows back into the business is creating real, tangible value for shareholders. This is when growth is a beautiful thing. We want this.
But, and this is so important, if the ROIC is less than the WACC, that company is actively destroying value. It's basically taking money and investing it in projects that don't even earn back what the money cost in the first place. In this situation, growth is actually a terrible, terrible thing. The faster this kind of company grows, the more of its shareholders' money it literally sets on fire.
Whew, okay, I know that was a lot. So let's pull all these threads together. Let's build a simple, powerful framework that you can use to protect yourself from that single metric PE trap for good.
I want you to think of a really solid investment case as a three-legged stool. You need all three legs or the whole thing just topples over. Leg number one, profitability. Is that E for earnings real? Is it high quality? And are you looking at the diluted number? Leg number two, valuation. Is the P/E ratio you're paying fair considering the company's growth and its risks? And finally, leg number three, maybe the most important one, quality of growth. Is the company's growth actually making you richer? Is that ROIC higher than the WACC? You need a solid yes to all three of those questions before you can feel truly confident.
So in the end, that PE ratio, it isn't an answer at all. It's a question. It's the first chapter of a much deeper story. A story about earnings quality, about growth, about risk, and about whether a company knows how to create real value. The numbers tell a story. The only question is, are you ready to listen?